Welcome to the Growth Minded Accountant podcast, where our experts will share best practices on running your firm in the digital age. This podcast is brought to you by CountingWorks Pro. Let's get started.
Welcome back to another episode of the Growth Minded Accountant. My name is Lee Reams. I'm the founder and CEO of CountingWorks and our sister company, TaxBuzz.com. Today, we're pivoting a little bit, and kind of the discussions we've been doing lately have been a lot about advisory work, how to stand out, how to position your firm, how to be relatable. So a lot of things that I think help in the selling process. But we're going to dig a little deeper into an area that I think a lot of accountants are missing, and that's client capital decisions. So we call it capital advisory. There's a bunch of different ways to talk about it, but I think this conversation matters for most business owners. And I think kind of the way it works for them is, hey, they chase capital after they feel pain, right? They don't understand the true cost of capital, which is even worse. They optimize for getting money, not necessarily keeping control or cash flow. And then, who do they talk to? They talk to bankers, brokers, investors, and a lot of times they do this before they ever talk to their accountant. And as the title of our podcast is, The Growth Minded Accountant, we think accountants are really, really important. So, the accountants are the only advisors who actually see real cash flow reality and real budgets. They understand tax impact over time. So what you do. They understand long-term exit consequences. And then, they also help capital, brokers and bankers decide what you're going to get as far as how much they're going to underwrite, things like that. So today, my guest is Sven Nelson. He's the founder and owner of Aevi Business Capital. He has over 2 decades of experience in commercial finance. So we're going to talk a little bit more about, I'd say, small, medium-sized lending, debt, and perhaps lines of credit. So Sven, if you could introduce yourself and give a little bit of background of, why you're in this business, why you love it, and how you're helping business owners.
Absolutely. Thanks for having me here, Lee. Really appreciate it. So I've been in the commercial collections for over and commercial finance for over 2 decades. Currently own a commercial collection agency. We've helped tens of thousands of clients collect over 650 million in bad debt. And throughout my career in that time in that business, I noticed that, a lot of these business owners that were ending up in collections really didn't need to. And necessarily doesn't mean that they're a bad person. They're usually a good person in a bad situation. And I felt like if they had some education around capital and where to get capital, they might not end up in collections. So I started this company back in 2022 with my son, Logan.
So you actually backed it, you reversed it. You went to the people that should have made these decisions already. And then they're like, whoa, man, if they had listened or done some things previously, they wouldn't be in that situation. That's very interesting. And why do you think that is so true? Because they're not getting enough proactive advice, or is it because they don't understand? They always think of lending as going to your bank, why do you think they get to that point where they're actually in the collections situation versus having, cash flow funded by a debt or a credit line?
I think it's a combination of all the things you mentioned. It's a lack of education. It's a lack of knowledge of where to go. And really, it's a lack of what is actually out there and available to them. And so those are the answers that we try to give these folks throughout our process when we're trying to help them find capital for their business.
Okay, so I'm going to break down what capital, like a strategy, looks like, and then maybe some different categories, and then get into the type that you're obviously not doing private equity, you're not doing venture capital. Those are for different uses, but you're doing credit lines. You help people with term debt. You help people with SBA loans. I've heard credit card stacking. I've heard all kinds of things, but kind of explain, to me, let's just start out when a business owner is realizing, hey, I want to grow. I have some event or pain point that says I need extra capital, right? So either that helps me grow faster. Perhaps I have some vendors who aren't paying me as much. Maybe it gets me through a down period. Maybe the tariffs created, headwinds for my business temporarily and they caught up. So kind of explain to me, when you meet with a small business, medium-sized business, how do you go through this discussion to kind of get into an idea of the root of the problem and then trying to figure out how to get a solution for them?
Yeah, so that's a great question. So we have an entire marketplace of all the options you mentioned. It's term loans, lines of credit, 0% interest, credit card stacking, some startup funding, anything from factoring to PO financing. And we want to take them through that entire marketplace without them having a hard pull on their credit. So having a conversation with them first to figure out what is the actual use case of this money. Are they coming to me thinking they need a line of credit and then they're going to buy a piece of capital equipment with it? Well, that doesn't really jive. So that's not the right use case. And many people just don't understand, what types of capital are out there, and they don't know how to utilize them. They've heard, a buzzword of line of credit, and they all come to me thinking they want a line of credit, but it's not really the best use case for specific scenarios. So we're going to sit down with them. We're going to do a soft pull. We're going to basically kind of underwrite them for a couple, or pre-qualify them rather, for a couple of our approaches, and then we're going to talk with them about their plans for the future and really build a roadmap so we can actually get them the right type of funding as their business grows.
So I think I'm going to step back a couple before we talk about just like the types of loans, but let's just talk about how do you advise somebody? What are like the different use cases someone's coming to you? You know what? They're coming to you in an emergency. Maybe that's a different discussion. They're coming, let's say they maybe picked on a big client, or they had, a couple months in a row of large revenue growth and they need to hire more employees. So how does this capital advisory side, how do you walk people through kind of like, okay, this is what you really need, and these are now some of the products that might fit, helping you get there?
Yeah, so I mean, in a perfect world, we want to get to them before they get to that point of desperation, because when you're in a point of desperation, you're acting from emotion rather than logic, if that makes sense. And so we want to interview these people, get to know them, get to know their business, their goals, and what exactly are they using that capital for. I know they may tell me working capital, but are they going to go hire employees? Are they trying to supplement some receivables and some cash flow that way? How much time do we have before they actually need the capital? And that has a lot to do with the route that we'll take them as well. So we're going to have that conversation with them, understand what their needs are, and then match our particular solution to their particular goals and what they're trying to achieve. I hope that answers your question, Lee.
Yeah, and so let's go back to uh, the traditional. And you said, well, people always think they want a line of credits. You know why? Because they think line of credits are easier to get. So it's less friction for me. I don't have to pull as many documents. Perhaps I can now do an online application and get underwritten in minutes, right? But let's talk about kind of the traditional thought processes of what I'm going to call lending was always thought through a bank or
Yep.
maybe a credit union or something like that. And let's back up and just kind of explain to me, what does that ecosystem look like versus the ecosystem you play in? I think you do work with banks as well, but kind of get
Correct.
an idea so business owners understand the differences, the pros and cons, the struggles, why I might go one direction or the other.
Yeah, so going to your bank is always a good choice, but the reality is that they have one particular or maybe two particular products that they're going to try to fit you into, and if you don't fit that mold, then there's nothing they can do for you. So working with us as a broker, we have many different banks, many different solutions, many different loan types, and we can actually match your use case to our solution versus just trying to fit a round peg into a square hole. In other words, we don't want you to just look at one particular option. We want to look at all the options for you at once rather than just pigeonholing you into one particular solution that a bank might offer.
Okay, so let's give a use case. So a business owner comes to you. This one is, I'm a growing business. I'm
Mhm.
starting to take off, and because I'm taking off, I'm spending more money on R&D or some product development, and then perhaps my profits actually have shrunk a little bit, and so my cash flow is a little tighter, but my revenue top line number is growing and growing. How would you sit down and talk to me about? Okay, how much money do you need? Is there a time horizon? What is the cost of capital? Kind of explain that exercise for me.
Yeah, so looking at what they're taking in versus what they're needing to use, we're going to build that plan with them by looking at, what are their bank records going to show, right? What are their tax returns going to show? Does their current financials match what their tax year was previously, right? Because if those financials currently don't match what they were doing, because like you said, their revenue has gone up, but their profits have gone down, they're not necessarily going to be able to utilize that money that was on those tax returns that they were showing, right? So we might do like a personal term loan, or we might do some alternative lending through credit card stacking, or we might do a business term loan or an SBA, right? So there's different programs that we could take them to. Let's just say that they needed a piece of equipment, right? And they only needed that piece of equipment. Then we can just look at an actual equipment financing versus, an entire line of credit. Because when you go to get a line of credit, they're going to look at your tax returns. They're going to look at your current financials. And if those aren't matching up and you've got some holes there, then it's going to be harder for you to get that line of credit, right? And many people don't know this, but geographically, lines of credit are not all easy to get. Like, for instance, on the West Coast, it's a lot harder to get a line of credit than it is on the East Coast. And that's just because the banking environment is different in those particular geographic locations. So the banks on the West Coast may be a little more lenient, or I'm sorry, on the East Coast, maybe a little more lenient when it comes to a line of credit versus the West Coast. And so it's our job to know that and to put you with the right particular institution so that you've got the right options being offered to you at that point in time.
That's very interesting. I had no idea. So, before we continue talking through, I want to talk your view on how an accountant should be involved. And, before capital is raised, before a debt or a funding decision is made. So, what are they doing? They're normalizing financials. They're doing any add backs. They're doing stress testing on cash flow. They're analyzing things. They're aligning capital choice with your exit goals. Then they're walking through maybe some of this jargon, some of these things. I don't know what an SBA loan versus a credit card stack means, right? So how do
Right.
you think the accountant, a CPA, an EA, even a bookkeeper for that matter, how should they be involved in this discussion before they actually go to a source like you?
Yeah, I mean, I think as an accountant, you should be asking your clients, what kind of goals do they have? What kind of capital is going to be needed to reach those goals? And, it should be done on a 12-month, 6-month, and then, 2, 3 year plan, 5-year plan, because each one of these capital solutions has a certain criteria that you need to meet before you can actually qualify for them. And so we take people from startup all the way to existing revenue businesses and help them move up the capital solutions ladder, if you will, to get to each one of those certain types of capital if need be.
And I would look at it where I feel the accountant should be the first call, not the cleanup crew that are they come to you and
100%.
say, "Oh yeah, I pulled this line of credit or I did this," and the accountant's like, "What did you do?" They should probably be translating what capital, so understand what private equity is, what venture is, as a different source, understanding private banking versus the broker type of environment, and I think kind of translating what everything means so that when you come in to work with someone like you, you already know what the problem you're trying to solve with this capital, right? What happens if growth is actually slower than expected? Are we going to get ourselves in trouble? And as you said, what does success look like in 3 years, 5 years? Does this affect my exit if I have debt on the books, right? So there's a lot of things. So I think what people don't understand, I think capital decisions are irreversible moments, right? So if accountants
Absolutely.
aren't in the room before the money shows up, they're just managing the consequences of this. So I want to say, in your judgment, do people who have really well done books and CPAs that are guiding them, are they making better financial decisions than perhaps someone, DIYing it and just throwing it, trying to figure out, even from your point of view, isn't it easier for them to get a loan or set up some sort of line of credit?
100%. Yeah. The people that their accountants are proactively involved into this make way better capital decisions. They have more capital allocation. They don't get themselves in trouble with what I call these button loans or MCAs. I don't know if this is a good time to talk about that or not, but every
Sure.
single one of
No,
your
hey,
accountants.
talk about it. We want to. So what I'm
Yeah.
trying to do here is one is talk about the role of an accounting firm, and I'm also talking to business owners and for accountants to understand too. What are these different products and how would they work and things that you throw out numbers and whatever. There are products out there that are really beneficial. So yeah, explain them.
Yeah, so there's products that are beneficial and there are also products that are bad. I'm sure every single one of your accountants that's listening to this has had somebody show up and said, hey, I've gotten myself in trouble. I've got this loan, and they're taking out payments daily and weekly. And what they're referring to is something called an MCA, or merchant cash advance. And what it is, it's an advance on future receivables. And they don't actually have an interest rate. They have what's called a factor rate. And let's say that you borrow 100,000, you get a 1.4 factor rate. That means you're going to pay back 140,000, but it's not going to be in a long-term loan. It's going to be in a short term, like 3 months, 6 months, 8 months, all the way up to 12 months sometimes. But these loans, they do serve a purpose, but most businesses aren't educated about the cash flow and what they actually do to their business. So, part of what we do is educate people away from those types of solutions, try to offer alternative solutions to those methods, and then work with the accountants and everybody to get the paperwork and all the bookkeeping and everything that we need to get these clients qualified.
So let's go in a little detail then. So we have term loans, line of credits, SBA loans, alternative or this revenue-based funding is what you were just basically talking about. I don't know exactly what credit card stacking is, but if I say those are the five main categories that you match clients with.
We also have equipment loans, invoice factoring, PO financing, personal term loans. A lot of times business owners don't realize that, they don't quite have business credit figured out, right? They don't even have a business credit score. So it falls back on their personal credit. And usually these days, business loans are a combination of their personal credit and their business credit both. So the unicorn loan that's out there is one that's solely based on business credit, and those loans are, while they're out there, a lot harder to qualify for, and most small to medium-sized businesses really aren't going to qualify for them, so they're not going to be existent. But as far as the options that are out there, there's a whole marketplace that we try to fit people into, and then just educate them about some of the other alternatives that are out there that are really drastically harmful to their business and their cash flow. Because at the end of the day, it really comes down to cash flow, right? So that's how you get any sort of growth, is you're able to manage your cash flow throughout that time period of growth as well. And that's what we focus on.
So what would you consider the most common mistakes you see businesses doing when they apply for funding, even before, right? So I think we've identified not having clean books, not having strong credit,
Yeah.
not knowing what you're going to do with the money or planning ahead for the money. But, how do you address that, or kind of, what would be your advice to kind of make this process easier?
Yeah, I mean, I think it's important for every business owner to get with somebody like us who has their best interests at heart, before they make any moves. Because, like we talked about the MCAs, where, you're an accountant and you see this money coming out of their account every week. That mistake's already been made, right? Now that capital is not only super expensive, but it becomes really expensive to get out of it too. Because if you're, promising your future receivables away, that's a big chunk of your cash flow, and people just don't realize what that actually means to their books. So, I mean, the mistakes that are common are people just, applying for those button loans. They can get them on any number of websites by, just clicking a button, sharing their bank statements, filling out an application, and they can have money within 24 to 48 hours. But the real cost of that loan doesn't show up until they start to see the subtraction in their cash flow, in their daily cash flow, right? And then, just being prepared with what is the use case for this capital, right? If like I've mentioned earlier, if you're going to go buy a piece of capital equipment, well, you certainly don't want to go buy it on a line of credit. You want to get a term loan or equipment loan for that. So working with a partner that understands the different use cases for these types of loans, and partners you or pairs you up with the right solution for what you're trying to get. Those are some of the most common mistakes. And then, people not really being truthful or honest on their application, about their revenue, or about, what their take home is, and they intermingle things. So you definitely have to have some honest conversations with people, and you really have to drill down into, what the reality is versus what they're telling you sometimes.
So then this kind of brings up, we've talked before I had you as a guest. I was telling you how, and I have no idea how I got on these databases, but I had an old company that is basically a shell now. But for whatever reason, every lender in the universe calls me, spams me, texts me, bothers me every single day. I say stop calling, I put them on block lists, but
Yeah.
exactly what is that part of the industry? And I think it gives a black eye kind of to the broker side of things. I mean, are they just chasing people and putting them in bad products, or are they finding you on some, database, and once you're on it, it's just the Wild West? But kind of explain that experience, because I'm sure a lot of business owners are experiencing the same thing.
Yeah, 100%. I mean, even myself as a business owner, I get those types of offers on a regular basis, and I would say the majority of them are probably selling or pitching those MCAs or merchant cash advance loans that are harmful to your business. I don't think it's a great way to market, so I don't particularly do it, but there's also, credit triggers. So people can buy lists where there's been a certain trigger within your credit report that you're looking for something. They can buy, signals based off of that. I mean, there's all sorts of list sellers and industry, folks out there that will sell you leads. I guess I get emails for people trying to sell this to me all the time. So I think that, the best way to market is, through referrals and building actual partnerships. Me personally, so I don't really have any experience marketing in that way. It just doesn't seem like it's very efficient and certainly not what I would want to do. So.
Yeah, I was thinking of just replying with your number and said I had a number change, and see if that helps, and you could handle them. So let's talk about patterns you see amongst businesses that use capital well. So the
Yep.
idea is, if I'm going to borrow money and it's going to cost me something, it's going to give me an ROI, right? It's going to help me
Sure.
get to that promised land, or get me that equipment, or get my revenue from 1 million to 2 million, or
Yep.
and more. But kind of, what is your thought process on that?
Yeah, I mean, why don't I just give you kind of a use case here, or just kind of a case study on somebody that we recently helped. So we were referred, it was a construction team, it was a husband and wife team. They were running a construction company. They had 2 years in business, but they didn't quite have 2 years tax returns. They started using their personal credit cards to bridge cash flow gaps from some long outstanding receivables that they had out there that they knew were coming in. So we needed to do two things. We needed to restructure the high interest credit card debt and give them some relief on their cash flow there, because they were just making the minimum payments. Their credit scores had stalled and they were actually starting to lose in their credit scores. And then we had to get them some additional working capital so that they could bridge the gap between when those receivables were coming in and when they actually did get them, right? So what we did is refinance their large interest debt into structured term loans with structured fixed interest payments, and that dramatically raised their credit scores, right? Because their utilization went down on their credit cards. At that point in time, we needed to then get them some additional working capital, and so what we did is we did a credit card stack. And for those of you who aren't familiar with what a credit card stack is, we'll get several personal and business credit cards for a particular individual that have a 0% introductory rate. So anywhere from 12, 18, 21, all the way up to 24 months, sometimes on those introductory periods. So that gives the business that extra working capital. They can then take that money and provide themselves some runway while they're waiting for those receivables to come in. And then you might say, well, what if they get stuck and they're not able to pay those credit cards off in the allotted time? Well, that's when we would restructure them and then, put them on a different separate term loan to try to restructure those. For this particular customer, they're planning to come back to us in, 6 months to a year and maybe try to get an SBA or a traditional conventional line of credit. But after they did the stacking, their scores went up even further, and they were able to have that working capital to access. And obviously, we restructured the high interest debt for them. So provided some real relief for them on their cash flow, and again, provided the additional working capital. So those are some of the examples that, that's kind of an example of what we can do for you.
I'm laughing because I just got a spam call from a lender while we were on the phone. I have my Apple Watch on. I'm like, there it is, spam. Delete. Hang up. I'm not kidding. I probably get them every hour. But so let's talk about now. I think the real key here is the growth minded accountant, and talk about working with accountants. How, from your point of view, and you have relationships. We started working with your firm as a kind of a referral partner, as a lending partner for CountingWorks Pro clients, and we actually created a capital advisory playbook. So what is that? That's kind of like an outbound autopilot marketing platform that we do blog content. We talk about what credit card stacking is. We talk about term loans. We talk about the difference between going to your bank versus going to a broker. We talk about what private equity and VC is versus, again, lines of credit and debt. And it really helps educate the audience and small business owners. I think that's the biggest issue. A lot of times they're just pounded where there's a perception that they need something and I'm getting spam calls, or I do need something, I'm in an emergency, and I go online and it's the Wild West. So we like to see the runway. We like to kind of educate people what's out there, create relationships for them so they actually understand, hey, maybe I should look at, at this. Let me talk to my accountant first. And then if my accountant says, yeah, this is where you are, if you want to go this direction, and maybe I'll connect you with someone like you, but kind of explain then how you work with accountants to help, make this process one, high level. You're not putting people into loans they shouldn't be in. You're taking care of that relationship that the CPA has with their client, but kind of explain how you do that today.
Yeah, absolutely. So we get a lot of referrals from a lot of different accounting firms, and we work very well with accounting firms because the accounting firm is going to know what the actual cash flow is in the business, even though the business owner might not understand that. And so we can work with them to get the information, obviously with the permission of the business owner, but help them build a roadmap to not just fill a current void or need, but also future need, right? We can build that plan out so they know every step of the way where that capital allocation is coming from and what benchmarks they need to meet to actually get to that particular solution on the capital ladder, if you will. So, working with these accountants actually gives us an opportunity to do that. And obviously, protecting that relationship with their customer is key because we're not out there hard selling people. We're presenting options and providing the information and educating them. A lot of our accountants actually go on and bring all of their accounting firm on with us. We educate them about the different loan types and what options are out there so that their customers can go out there and be informed and what to look out for. And they know what to look out for with their customers. But the main thing is really getting to these customers before they make that bad mistake on their own, just going out and willy-nilly applying for a bunch of capital. And that's another thing you really want to warn your customers about is, every time they apply for something, they're getting a hard inquiry, right? So, and although one or two hard inquiries isn't a big deal, the more they get, they add up, and eventually lenders don't really want to do business with somebody that looks desperate for cash. So what's great about our method is that we're going to do this off a soft pull until we kind of nail down exactly what solution we're looking for, and then we do the hard pull when we're ready to apply for that particular solution. So using a soft pull to pre-qualify people is key. And that's one of the things that we do that doesn't actually harm the end customer from a standpoint of pre-qualifying them and getting them ready. So accountants should be definitely feel good about referring somebody over to us, knowing that we're going to educate their client and work with them, and then do that initial pre-qual off of a soft pull that's not going to hurt their customer just for taking a peek underneath the hood, right?
Yeah, no, I think that's great. So let's talk about something that you brought up, I think is interesting. It sounds like depending on what stage my business is in would kind of dictate what my options are. So you're saying under 24 months, you're limited. Is there a revenue range and a time in service that kind of dictates how lendable you are? So that'd be my first question. And then if you're providing advice and working with the accountant, how do you guide someone in that beginning side? Shouldn't this be a conversation they have like when they're starting out? That's why I say I think accountants should be 100% in the capital advisory. I think it should be a new category for them.
Yes.
When you're doing business entity planning, you take it from there and now get into capital advisory. But kind of explain, there's a two-part question here. Are there different stages and/or maturity levels which opens things up? And then you have different advice. And then why is it so important to have a plan for each stage?
Yeah, so there are different revenue based criteria that you have to meet. There's also time in business, there's also industry, and all those are dependent on the different types of loans that we're looking at. initially when somebody's starting out, they're going to qualify for term loans, maybe some startup capital. There's even a startup SBA program. There's an credit card processing, or not sorry, credit card stacking, which is an alternative source, right? That's more of the startup stuff. And then once a business is past that 24-month mark and they've been in business for a while, they have 2 years tax returns, and they're actually starting to show some profit. Then they might look at a traditional SBA loan or a conventional loan through a bank or a conventional line of credit. Equipment loans can be done either early on or later on. PO financing and factoring, again, you're going to look at throughout the entire course of the thing. So we're just going to look at their entire situation and then match them up to the scenario based on that criteria. And there's way too much criteria for me to go over to actually quote specifics based on all of those, but that's really what it comes down to. And then what was the second part of your question, Lee? I'm sorry.
Well, I was saying how then the accountant should be involved. So, for
Yeah.
example, I look at CountingWorks Pro and our platform and what we're doing with Max AI and kind of looking at our clients and helping them segment their clients. And where I'm getting at this, I'm just thinking, out loud,
Sure.
we should probably be categorizing their client base for them. So these business clients are in this stage. And then when it comes to the capital advisory side, right? And this size is in this stage and this is in this stage. So then we can actually even push the right type of content to them. So an email that goes out, we're not talking about credit card stacking if a firm is going from 5 million to 10 million and they're
Correct.
buying, a building, for example, right? So I
Yeah.
just want to match the messaging kind of with the advisory and how technology and or CPAs should be communicating to their clients.
Yeah, so I mean, obviously, I mean, when you first take on a client, I mean, send them over to a capital advisory service because, they can help build that roadmap with you. And then I would say doing constant check-ins with these particular clients on a regular basis. I don't know if you do that quarterly or if you do that, at half a year or every other year or whatever. But as long as you're looking to, I mean, most of these businesses that you're dealing with are looking to grow, and so they're going to have a need for capital. And as far as what capital you want to market to them at what stage in the game, I mean, businesses that are over 2 years, I wouldn't really necessarily tell you to market any specific type of capital per se, as I would just having the conversation with somebody like us. Because if you get too far into the weeds, you may suggest something that isn't really a great fit after we learn the whole story. And then the customer has that in their mind that, hey, they want this, but really they need this, if that makes sense.
No,
Um,
it does. And I think my goal here is, and what I'm trying to communicate and I'm trying to get it out, right,
yeah,
is
yeah, yeah.
you don't want to turn accountants into lenders.
Correct.
You're there to help educate your existing client base and then let them raise their hand when capital becomes relevant because you've been telling them, this phase, this might be a good time to look at this option. And at that point, they kind of self-select. And that's kind of the whole concept of what we built in our playbooks at CountingWorks Pro. The playbook itself is doing the heavy lifting, right? It publishes educational content. It sends out those emails to your clients, even if you're not having that quarterly or monthly advisory meeting. It creates FAQ pages that are going to feed ChatGPT and Google, right? So that, even if people are searching for this help, your brand, you as the advisor, the CPA, are going to start showing up. So it gives you a lot of different ways to kind of help your clients and really do well. So that's kind of I was trying to walk you around it to
Yeah,
get you
yeah, yeah,
there.
yeah. Well, I think the main thing is, Lee, is that you don't want your clients to be making a capital decision from a point of desperation or emotion, right? Which is where many people actually start to look for capital is when they're already struggling or they see a cash flow gap. But in reality, the best time to apply for capital and to plan for capital is before you actually need it, because the options that become available to you when you're desperate and when you're operating from a spot of emotion aren't the ones that you want to take. Those
Right.
are the ones that become really, really expensive, and it's a costly mistake that you don't want to make again and again. So if there's anything I could tell your clients, it's to, come to us before you actually need the capital. Get ready for whatever expenses you see in the future, and then maybe even some that you didn't plan for, right? Make sure that you have knowledge about what opportunities and options are out there for you to preserve your cash flow and protect yourself in times when things are slow or receivables aren't coming in or what have you, right? So you just want to prepare way in advance rather than operating from behind. It's going to just save you a ton of money and headaches for sure.
Right. I mean, I'll even go as far as like a line of credit. I had a colleague whose business had a large line of credit, and they had it just sitting there as kind of like an emergency back
Yeah.
stop, so to speak. But then they had an opportunity to buy a business very quickly, and they just used the line of credit. They just pulled, $1.5 million out of the line of credit, bought the business and for cash and moved on. They didn't have to go through this long process of trying to finance it or do it in a different way. And I think that's kind of the beauty of what planning is about. We're not talking about pushing loans, right? We're talking
No.
about giving your clients better guidance around capital. And because of this, I think you're building deeper advisory relationships as a result. And that goes into your CFO advisory, your tax advisory, the other side of your business. So, really important for accountants. We just wanted to kind of talk it over. I don't see this topic, capital advisory, mentioned as much in the CPA, the tax advisor, the EA market. So that's the reason I brought you on. That's why we created this program. So let's talk about this. We have a relationship with you. We will have a link in the bottom of this podcast that if someone is interested in setting up kind of a referral capital advisor relationship with you, they just basically sign up, put some general information on. Then what happens? You have an onboard call. You kind of get to know each other, the clients. This is even before you talk to the clients, but explain that process just
Yeah.
so an accountant, a CPA who is interested kind of understands how it works.
Yeah, absolutely. So they fill out the form. After they fill out the form, there's an agreement sent to them. They get their own link, and then there's a call that they can schedule with us, where we'll talk about how the capital advisory service works, and answer any questions they have about our options that are out there. And then we can even offer to do like an entire webinar with their entire staff, educating their staff as well. So, they get to know us and the program really well. And the great thing about us is that, we're never charging any of their clients anything up front. The only time we ever get paid is when we're actually successful in getting them funding. So a lot of our partners really love that because we're not asking them for money up front. So we get paid for success.
Well, hopefully that's what all of us are getting paid for, right? That's the
That's
whole
right.
point of advisory. You're providing a better financial outcome for your client. Hence, they're willing to spend more than they would if you're just a compliance only. So I think this has been extremely helpful. Again, I just wanted to introduce this to our audience. Those that are interested, if they want, please reach out to the contact information that I am going to put in the bottom of this discussion in the description. Is there anything that I have missed that you wanted to add, or did we cover this fairly well?
No, I think we did a great job covering it, and certainly we're here to answer any additional questions that anybody comes up with, and take care of their clients and take care of them. So, absolutely.
All right, awesome. So that wraps up this edition of the Growth Minded Accountant podcast. As I mentioned in our last one, I lied. I said we're going straight to 5 minute kind of quick hits for tax season. We will record the first one of those tomorrow. And then these are going to be really good things that you can use in your tax interviews this tax season. So I'm going to try to find different ways to kind of break down the psychology. How do you talk to clients? How do you ask them questions? Taking them from a compliance mindset to thinking and looking at you as an advisor, right? And that's kind of the goal with many of the things, just kind of where the industry is going, where technology is moving the industry, and quite honestly, where the opportunities are. I feel if I were a boutique CPA firm, I'd be all over capital advisory as a service, and I would make this again another part of what I'm doing for clients because right now I really feel it's the Wild West. I think most clients make decisions without you, and then you're in there again cleaning up. And I don't think that's the purpose of what you're trying to do for your clients. So hopefully this resonates with you. If you have any questions, feel free to reach out to myself on LinkedIn. Again, I'll put all the contact information below. But again, thank you for being a listener. We are like within 10 people of 7,500 subscribers. for our YouTube Growth Minded Accountant podcast channel. So I'm super excited. Even growing during tax season has been great. So thank you again for the support, and we'll continue educating you and giving you best practices throughout the season. Thank you.
Thanks for having me on, Lee. Appreciate it.
You got it.